On November 19, 1963, a commodity broker named Anthony DeAngelis filed for bankruptcy in a New Jersey courthouse. His company, Allied Crude Vegetable Oil Refining Corporation, listed debts of approximately $150 million and assets of approximately nothing. The assets were supposed to be oil. 1.8 billion pounds of soybean oil stored in 51 tanks at a waterfront facility in Bayonne, New Jersey. American Express had certified that the oil existed. Inspectors had physically visited the tanks and verified the contents.
Warehouse receipts had been issued, signed, and used as collateral for loans at some of the largest banks in the United States. When the receivers went to check the tanks, they found seawater. By the time the scale of what had happened fully emerged, American Express stock had fallen 40%, 51 banks, and brokerage firms had taken losses, and Warren Buffett had bought enough Amex shares to retire early if he wanted to. Anthony DeAngelis was born in the Bronx in 1915. He left school at 14. He worked in a series of food industry jobs, meat packing, food distribution, the commodity side of the agricultural economy, and he was, in most professional assessments, good at it. He understood supply chains. He understood the gap between where commodities were produced and where they were consumed. He understood leverage, in the practicals of the word, long before he understood it in the financial sense. His first significant business venture, in the late 1940s, was a hog rendering operation in New Jersey. The operation was found to have supplied adulterated lard to a government school lunch program. The USDA banned him from participating in government food programs. He paid a fine. He did not stop. By the mid-1950s, DeAngelis was trading in vegetable oils, cottonseed, soybean, other commodity oils used in food processing and industrial manufacturing. The commodity oil trade was unglamorous, physically cumbersome, and dominated by large agricultural companies that had established relationships with the banks and shipping companies. DeAngelis, operating as Allied Crude, operated in the margins of this industry. He found deals that the established players did not want. He moved volumes that the major traders found too small to bother with. And then, in the late 1950s, he found a much larger deal. The United States government, in the post-war era, had accumulated enormous stockpiles of surplus agricultural commodities. The program was called Food for Peace, later renamed PL 480. It allowed the United States to sell surplus grain and oil to developing countries at subsidized prices. The program needed brokers to handle the physical logistics. DeAngelis secured contracts to supply vegetable oil to Spain, Yugoslavia, and other nations participating in the program. The contracts were large. To fulfill them, he needed storage. He leased a facility at Bayonne, New Jersey, a former naval fuel depot on the waterfront of Newark Bay. Consisting of row upon row of large cylindrical storage tanks originally built to hold military fuel oil, he converted the tanks to store vegetable oil. Some of the tanks, at some points, did contain oil. The operational side of Allied Crude was real. He was genuinely moving commodity oil through the global food supply chain. But he was also speculating, and the speculation required capital he did not have. To understand how the fraud worked, you need to understand how commodity warehousing finance worked in 1960. A commodity trading operation that stores physical goods, oil, grain, metals, can use those stored goods as collateral for loans. A certified warehouse issues a receipt confirming that a specified quantity of a specified commodity is being stored on the owner's behalf. The owner takes that receipt to a bank. The bank lends money against it, treating the receipt as equivalent to the commodity itself. When the owner repays the loan, they reclaim the receipt and the commodity. The system requires the warehouse receipts to accurately represent what is in the warehouse. If they do not, the entire system of commodity-backed lending breaks down. American Express had a subsidiary called American Express Field Warehousing Corporation. Field warehousing was a specific variant of the warehouse receipt business. Instead of moving commodities to an Amex-operated warehouse, Amex would send inspectors to the customer's own facility, certify the contents, and issue receipts from that location. It was a convenient service. American Express was a trusted name. the warehouse receipts issued under the American Express Field Warehousing Seal were accepted by major banks as reliable collateral. DeAngelis hired American Express Field Warehousing to certify the contents of the buy-on tanks. The fraud was elegant in its physical simplicity. Oil, being lighter than water, floats. A tank that is 90% filled with seawater and 10% filled with oil, when measured from above, appears to contain oil. An inspector who does not know about the pipe network, who measures the oil at the surface of one tank, and who does not drain and inspect the lower portion of the tank, will record a full tank of oil. DeAngelis's crew could pump oil from one group of tanks into the tanks being inspected on any given day, then pump it back after the inspectors left. The same oil, moved around, could be certified multiple times at different locations. Receipts were issued for all of it. At the peak of the fraud, the warehouse receipts issued at buy-on certified the existence of approximately 1.8 billion pounds of soybean oil. This was more than the total estimated soybean oil inventory in the entire United States at that time. The discrepancy was visible in the public data published by the United States Department of Agriculture. Nobody checked. The borrowed money went into speculation. DeAngelis was using the fraudulently obtained capital to take enormous long positions in soybean oil futures on the Chicago Board of Trade. He believed, or claimed to believe, that soybean oil prices were going to rise. If they did, his futures positions would generate profits large enough to cover the borrowed capital and leave him with a fortune. The mechanism was a classic commodity corner attempt. By accumulating enough long futures contracts and enough physical supply, a trader can create a situation where anyone who is sold short is forced to buy from you at any price you demand. It is illegal. It has been attempted periodically throughout the history of commodity markets. It almost never works, because sustaining the corner requires continuous capital, and any disruption to the capital supply forces a liquidation at whatever price the market sets. DeAngelis's capital supply was the fraudulent warehouse receipts. The more receipts American Express issued, the more he could borrow. The more he borrowed, the more futures he bought. The bigger his futures position, the more he needed soybean prices to rise to justify the position. He was a man running faster and faster to stay in the same place. The American Express inspectors visited buy-on regularly. Their records showed the tanks to be full. Their records were based on measurements taken from the tops of the tanks. The floating oil surface was visible and measurable. What they could not see and did not test for was what was beneath the oil. The inspectors were not incompetent. They were conducting the inspections that their procedures specified. Their procedures did not include draining tanks, testing for salinity, checking the pipe network, or cross-referencing the certified inventory against the public USDA data on total available supply. The procedures assumed that a field warehousing inspection meant the stored commodity was what it appeared to be. This assumption had never been rigorously tested. When it was finally tested, at buy-on, it failed completely. In the summer of 1963, soybean oil prices began to fall. DeAngelis needed prices to rise. Instead, they were falling. His futures positions were losing money. He needed more capital to maintain his positions. He borrowed more, issuing more receipts, pledging more oil that was not there. By October 1963, several of the brokerage firms that had lent against the warehouse receipts were becoming nervous. The exposure was enormous. They began to ask questions. The questions were not yet the right questions. Nobody had gone to buy-on and drained a tank. But the volume of receipts was becoming difficult to explain. In November, one of the brokerage firms, Ira Haupt and Company, received a margin call it could not meet. Its exposure to Allied crude was so large that the call was existential. On November 19, Allied crude filed bankruptcy. Ira Haupt and Company was suspended from the New York Stock Exchange the same day. Two other firms followed. The commodity futures market for soybean oil was in free fall. American Express's exposure was existential. The firm had certified the warehouse receipts. If the courts found that American Express field warehousing bore legal liability, the company could face claims of $150 million or more. American Express's entire net worth was approximately $80 million at the time. The firm could not cover the claims. The stock market understood this immediately. American Express shares, which had been trading around $60, fell to $35 in the weeks following the collapse. The company's board began evaluating whether to wind down the field warehousing subsidiary, settle with the creditors for whatever it could afford, or fight the liability in court. There were serious arguments for fighting. American Express Field Warehousing had been deceived. Its inspectors had followed their procedures. The company had not been negligent in any conventional sense. The counter-argument was simpler. The receipts said American Express. People had lent money because they trusted American Express. The trust was misplaced. Somebody had to absorb the loss. Warren Buffett was 33 years old in 1963 and managing a partnership out of Omaha, Nebraska that had approximately $9 million in assets. He had been trained by Benjamin Graham and had spent the previous decade applying Graham's methods with exceptional results. He was not yet famous. He was not yet rich by the standards he would later establish. He was a disciplined value investor, looking for situations where a business was worth significantly more than its current stock price implied. He noticed the American Express situation. His method was not to read analysts' reports or consult financial advisors. His method was to go where the business was happening and observe. He went to steakhouses in Omaha and watched the customers pay. He went to travel agencies and watched the transactions. He went to banks and asked about travelers' checks. Everywhere he looked, he saw the same thing. People were still using American Express products. The consumer-facing brand, which was the actual business, was operating normally. The salad oil liability was terrible. The business was fine. He put approximately 40% of his partnership's assets into American Express stock. This was a concentration that Benjamin Graham would never have recommended. Graham believed in diversification. Buffett, in this case, believed in his own analysis. He was right. American Express settled its oil fraud liability over several years for approximately $60 million. The stock eventually recovered and then significantly exceeded its pre-scandal price. Buffett's position in American Express became one of the foundational investments of his career. DeAngelis was arrested in 1963. He was convicted in 1965 on fraud and conspiracy charges. He was sentenced to 20 years in federal prison. He served approximately 7 years and was released in 1972. After his release, he attempted to re-enter the commodity trading business. He was eventually banned from the industry. He died in 2015 at the age of 96. The American Express Field Warehousing subsidiary was shut down. Ira Haupt and Company, one of the oldest commodity brokerage firms in the United States, did not survive. The New York Stock Exchange arranged an emergency rescue by member firms. The first time the exchange had taken such action to protect the creditors of a failed member. The rescue fund paid customers 50 cents on the dollar. The firm was liquidated. What the salad oil scandal established was the nature of systemic trust in commodity finance. The warehouse receipt system worked because everyone in the chain assumed the receipts accurately represented physical commodities. American Express's seal meant the oil was there. The banks did not send their own inspectors. They did not cross-check the certified inventory against available supply data. DeAngelis understood this. The fraud did not require bribing inspectors or forging documents. It required only that the inspectors follow their procedures correctly and that those procedures contain an exploitable gap. The connected pipe system was the gap. Once DeAngelis understood that the inspectors measured from above and never drained a tank, the architecture of the fraud was complete. There is a detail about the scale of the fraud that is worth sitting with for a moment. The data existed. The discrepancy was real and measurable. The check was never performed. This is the normal operating structure of a system based on institutional trust. Nobody verifies the foundation. The foundation is the institutional name on the document. When the name is reliable, the system works. When the name is attached to a fraudulent document, the system accepts the document without checking the name's work. In the year after the scandal, American Express conducted an internal review. The review recommended that field inspections include tank drainage testing, salinity checks, and cross-referencing against USDA data. The recommendations were not implemented. The field warehousing subsidiary was simply closed. The recommendations were presented to the board, noted in the minutes, and filed. None of them addressed the fundamental vulnerability. The moment of inspection is the only moment at which the certified commodity is actually verified, and that moment can be manipulated by anyone who controls the physical infrastructure being inspected. The specific physical mechanism that De Angelis used, the underground pipe network, has been documented. What is less documented is how widely known this technique was within the industry. There are suggestions in the trial record that connected tank systems were a known feature of large storage facilities, and that the practice of pumping between tanks was understood by experienced commodity traders. The gap in the methodology was real. Whether it was unknown to everyone or simply unacknowledged by everyone is a question the record does not resolve. Warren Buffett has told the American Express story many times in the years since. He uses it to illustrate what he calls the circle of competence. Another is the idea of buying a great business at a fair price rather than a fair business at a great price. American Express in 1963 was a great business temporarily available at a price that assumed it might not survive. Separating those two things, the temporary damage from the permanent franchise, was the analytical work that produced the return. The fraud, the gap, the loss, and the recovery all followed each other in sequence. The sequence is familiar. The gap exists, the gap is exploited, the losses accumulate, the reforms are proposed, the reforms are partially implemented, the gap is not entirely closed, and eventually someone finds a version of the gap that the reforms did not address. The oil tanks at Bayonne are still there. The facility has changed hands several times. It is currently used for petroleum storage. The underground pipe network that connected the tanks in 1963 was removed at some point in the subsequent decades, and the USDA publishes monthly commodity oil inventory data every month as it did in 1963, cross-referenced and publicly available to anyone who wants to check whether the numbers at any given storage facility are consistent with the total estimated supply in the entire country. Nobody is required to look.